Hello everyone, John A.G. here. Let me tell you exactly what just went down. The U.S. Justice Department has now issued grand jury subpoenas targeting the Federal Reserve, and there's talk, serious talk, about potential criminal investigations. The Fed chair didn't hold back either, firing back publicly. That single exchange lit a fuse across global markets. You can already see the first reaction in one place. Gold and silver prices are surging as 2026 begins. Now, you might be thinking, John, is this just another news flash that won't matter? Stick with me. When the people who set interest rates start looking like they're under legal fire, markets don't shrug it off. They adjust quietly at first, then all at once. Before we dive deeper, a quick favor. I'm running a campaign against channels that copy content and drown out original research. If you get real value from what I share, hit subscribe and drop OG John AG in the comments. It takes 2 seconds, and it tells the algorithm you're here for the real insights. I've also created a WhatsApp channel for daily updates, short posts, and voice notes when breaking news hits, stuff I don't always post on YouTube. Links in the description. Join it because the market doesn't wait for uploads. Now let's break down the week. It didn't start with a chart, it started with a warning. The Fed chair steps forward, confirms subpoenas, and frames the issue as pressure linked to interest rate decisions, not just bureaucracy. That's the headline. And whether you love, hate, or distrust the Fed, the implication is identical. If monetary policy starts being influenced by outside pressure, risk-free stops being risk-free. Bonds jitter, the dollar's narrative weakens, and hard assets suddenly get louder. 2 weeks into 2026, metals are reacting like they sense the shift before anyone else. Gold isn't surging because a single analyst got excited. Silver isn't rallying because social media buzzed. These moves happen when institutional trust begins leaking, and nobody wants to hold paper promises as the cracks widen. Here's what most people miss. This isn't a sprint, it's a marathon. And we've been running it for years. The past few years made it visible enough for average investors to notice. So today, we'll tackle 3 things every serious investor should follow. First, we'll connect the dots between headlines, subpoenas, Fed pressure, political heat, and the real-world effects on pricing. Second, we'll examine gold and silver's current behavior, why it matters, and signals suggesting this isn't over. Third, we'll expose the hidden scoreboard, how fast fiat currencies are losing buying power against metals globally, not just in one country, but everywhere. And yes, I'll leave you with 2 critical questions every investor must ask before the next leg of this move hits. Before we get into it, a quick note for those of you chasing silver success stories. If you want examples of people who positioned early and made serious gains, not theory, not doom, there's a dedicated channel linked below. Subscribe there too. Seeing real success makes the potential tangible. Now let's rewind to the moment that shifted the week. A public statement, a legal threat, and the central bank under a spotlight it never requested. Almost immediately, metals reacted. Gold surged in early 2026 with urgency similar to early 2025, but faster. Silver, often overlooked until it proves its strength, continued last year's trend, outperforming, over-delivering, forcing analysts to rethink assumptions. Here's the key. It's not about the price direction. It's about deviation from normal. These prices aren't just higher. There are multiple standard deviations above long-term behavior. The market is signaling change, while most people debate if anything is happening. Meanwhile, TV analysts ran the usual lines. Too fast? Too much? Expect pullbacks, don't get greedy? Sure, pullbacks happen. It's physics, not prophecy. But notice this. When multiple voices call a move once in a generation, they're inadvertently admitting the truth. Monetary regime shifts don't happen annually. Trust crises don't follow a calendar. And global rushes for tangible assets happen, while the average person acts like the old rules still matter. That's why phrases like secular trade are cropping up. A long-term shift, not a temporary spike. And it's not just gold. Copper is strong, platinum moves, palladium remains relevant. Silver is acting like it's keeping a hidden scoreboard. The reason isn't magic. It's supply, utility, and politics. The world now understands critical metals aren't optional, and they cannot be printed. Governments can posture, companies can promise, central banks can talk, but no one can instantly create a new mine. Supply-side constraints take years to resolve. I'm not here to dissect every quote or speculate on motives. You told me not to. I'm here to translate events into what matters for positioning. Because while headlines clash, flows move silently but powerfully. Let's focus on silver first, the most misunderstood metal. It's not just poor man's gold. That's lazy. Silver is a hybrid, a monetary metal and industrial workhorse. Gold is stored. Silver is used, consumed, and scattered across products, often never fully recovered. Combine investor demand with industrial demand, and you have a market ready to reprice sharply. Layer in whispers of multi-year supply deficits. Not a bad quarter, a slow drain of market flexibility. It's like draining a reservoir while assuming rain will refill it. Eventually, the faucet sputters, and price stops negotiating politely. So when silver flirts with psychological levels like triple digits, know what's happening. It's not just a number, it's a signal. Your currency buys less metal than before. And when that truth becomes obvious, behavior changes. The indifferents start caring, the skeptics start asking questions, the latecomers start panic buying, often at the peak of the first move, not the beginning of the trend. Next, let's zoom out globally. This bull market is uneven. Different regions see different prices, premiums, and shortages. Premiums are the first loud signal from the physical market. Rising premiums mean people pay above paper prices to hold real metal. That paper-physical gap shows stress first. Now, let's bring some clarity to the numbers most people overlook when emotions run high. Last week didn't just see metals drift, they surged, held, and closed strong. Silver ended the week around the low 90s per ounce, and the gold to silver ratio, it's tightening, roughly in the low 50s, meaning it takes just over 50 ounces of silver to buy 1 ounce of gold, dipping even lower intraday at points. That compression isn't trivia. It signals silver is being repriced for scarcity and utility, not just sentiment. For newcomers, this ratio matters. Gold usually leads during the first wave of distrust. Silver often leads when real-world demand amplifies and supply starts constraining the market. When the ratio drops, it's the market whispering, this move is broadening. Globally, while U.S. investors debate $100 silver, other markets already see triple-digit pricing after premiums. Why? The metal is physically harder to obtain, or local currencies are losing purchasing power faster, or both. China's physical silver market is particularly instructive. Premiums jump on and off, sometimes double digits above conventional spot prices. When a major economy pays 8 to 10% over spot, that's the real world calling the paper market's bluff. Even with premiums, Chinese stockpiles continue to fall. Latest figures suggest visible inventories under 40 million ounces. That sounds like plenty until you consider industrial consumption across an entire economy. When a market pays extra and still draws down inventory, the next wave of demand could ignite volatility. That's your first cliffhanger. Now, let's personalize this. Most people measure wealth in life goals, not charts, a home, land, business, freedom. Consider the number of silver ounces needed to buy a median-priced home. When that number drops, silver gains purchasing power versus housing, or housing becomes cheap relative to silver, or both. Hitting old historical zones isn't trivia. It signals a cycle shift. I'm not suggesting one asset must always outperform. I'm saying watch the ratios. They reveal truths hidden behind nominal prices. A stock index may look strong in dollars but weak in gold. Homes may appear stable in dollars but cheap in silver. That's how regime shifts become visible early. Now, let's get into the plumbing of metals markets, where things get even more revealing. Ongoing drawdowns and registered inventories continue, especially in Western vaults. Big bars are moving. Every time they shift, the question is, why? Industrial demand, investor flows, or arbitrage? Borrowing paper, converting to physical, and selling into higher premium markets? That last one exposes the subtle tension. Paper markets can create exposure without physical metal. Physical markets demand ounces. When large paper positions touch physical, the illusion becomes costly. Retail markets are telling a story too. Coins and smaller products spike in premium, sometimes dramatically above spot. It's not always collectibles. It often signals pipeline bottlenecks, slow production, or surging demand. That strain confirms physical scarcity is real, not just paper price movement. Here's the key. You don't need perfect knowledge. Spot patterns matter more. More pressure, more volatility, more repricing. That legal story at the center, it changes sentiment. If central banks are seen as politically pressured, investors question every rate decision, every inflation report, every press conference. And when doubt enters the room, people flock to hard assets. Digging deeper into inventories and flows, deliverable silver in major Western vaults has been declining steadily. Depending on the data source, tens of millions of ounces have exited deliverable categories recently. Why does this matter? Deliverable inventory is the backbone of paper markets. Shrinking it makes paper markets jumpier, more prone to gaps when real demand hits. Now, consider India. Over recent months, the country has quietly absorbed massive silver inflows into local investment vehicles. 1 month alone saw over 20 million ounces taken up, short-term totals approaching 50 million across multiple products. You don't need to worship these vehicles. You need to see the signal. Sustained physical demand is happening in markets willing to pay premiums. That's your second cliffhanger. If flows continue while inventories shrink, price is the only mechanism left to ration demand. Paper market stress also matters. Large funds and trusts show sudden drops in bar listings and lease rates spike. This hints at metal being borrowed and moved to high premium markets. It's not accusation, it's incentive. Borrow metal cheap, create paper exposure, deliver physical where it commands a premium. Arbitrage in action. And arbitrage continues only until physical markets say no. Lease rates are the interest rate of physical scarcity. Rising rates signal the market charging rent for being short real metal. Retail coin pricing does the same. When premiums spike dramatically, the pipeline between raw metal and product is strained, confirming the physical market's tightness. Ask yourself, if silver flirts with $100 in multiple regions, premiums remain elevated, inventories fall, and trust in institutions weakens, what stops the move? Massive new mine supply, that takes years. Industrial demand collapsing, that would require a severe economic shock, ironically pushing investors to metals. Policy restoring credibility overnight? Rare. Base case, continuation with sharp pullbacks. Those pullbacks shake weak hands, transferring metal from impatient to patient holders. Here's a practical framework. Allocate in tranches, not all in bets. Think in time frames, not tweets. Keep liquidity for volatility, because the next move won't announce politely. A lot of top callers aren't analyzing silver, they're analyzing fear. Price moves, fear rises, predictions follow. But markets respond to flows, constraints, and incentives, not comfort. Look at currencies like the Swiss franc or yen carry trades losing purchasing power against silver. That shows this isn't just a US story, it's a global fiat story. Picture the next 12 months. Continued currency debasement, stock indexes nominally stable due to liquidity, metals outperforming. Many will look at stocks and think all is fine, but gold 8S outperformance exposes the illusion of currency value. Add industrial demand spikes, investor fear, or geopolitical shocks disrupting supply chains, silver won't inch up, it'll jump. And when it jumps, media narratives change overnight. By then, the easy part is gone. That's why you're watching this. Now, let's get into what the market is showing right now. Gold is pushing toward fresh nominal highs, and the behavior matters. When an asset breaks out and holds near highs, it's different from a spike and collapse scenario. Holding strength signals buyers quietly allocating, even as institutional trust wobbles. Silver is even more dramatic. It doesn't appreciate politely. It compresses, frustrates, gets written off, and then moves fast, sometimes appearing manipulated, when it's really catching up to real supply-demand dynamics. Volatility? Absolutely. Pullbacks that scare people? Yes. Mainstream narratives calling tops repeatedly? Also yes. But none of that changes the structural setup. The drivers remain, and ignoring them is costly. Globally, the physical market tells a story beyond headlines. Key regions continue paying premiums, visible stockpiles shrink, and flows into vehicles claiming to hold metal persist. Think like a detective. When large volumes move to one place, is it new supply or relocated scarcity? If it's relocated, scarcity hasn't been solved, just shifted. And moving scarcity globally is what happens before price resets. One way to grasp this is to remember what $100 used to mean. A $100 bill used to buy real things. Today, in many markets, it struggles to buy an ounce of silver. This isn't a silver story, it's a currency story. And currency stories end in repricing, not polite press releases. Critical metals and national policy play a role too. Governments openly admit dependency on imports, a vulnerability. When they admit that, they either pay more to secure supply or attempt to control it via regulations. Either way, the price signal strengthens. A world racing to secure commodities is a world willing to pay higher prices, making old averages irrelevant. Community moment. If you've had wins in metals, business, or investing, share them in the comments. Not to brag, but to inspire. Seeing others succeed raises confidence across the board. While you're there, answer 2 questions. First, do you think legal pressure on central banks ends quietly or escalates into a broader confidence crisis? Second, if silver holds triple digits this year, which will surprise people more? The speed of the move or the overnight narrative shift? Drop your thoughts. I read them and it shapes future coverage. Now let's talk about the debasement trade. Sounds dramatic until you realize it's just math. When governments spend more than they collect, central banks expand balance sheets, and economies rely on perpetual credit, currency loses real purchasing power, sometimes slowly, sometimes abruptly. Gold and silver are the immutable scoreboard. You can alter CPI baskets, definitions, narratives, but you cannot print ounces. When metals signal stress, listen. People ask, how high can this go? I'm not giving outrageous clickbait targets. But in a regime change, historical ceilings can become floors. Old levels that held for decades get broken once the market decides the currency is the problem. The gold-silver ratio is another signal. Compression indicates silver outperforming gold, usually when the market transitions from fear to scarcity, from safe haven to real-world demand. Watch it. It's not trivia, it's the market signaling expansion of the move. A common objection. What if this is all paper hype? Short-term reversals can happen. Structural setups don't vanish overnight. A decade of underinvestment in supply doesn't reverse with a tweet. Rising industrial demand won't collapse due to one policy speech. Global currency debasement isn't cured by one good month of data. Pullbacks occur, but secular trends persist because drivers remain even when charts look scary. Cliffhanger. The next phase may be dominated by institutions that previously ignored metals. They don't buy one coin, they buy positions. In markets with constrained physical supply, that creates gaps and accelerates price movement. Narratives evolve. Mainstream opinion is still mixed. Some are optimistic, some skeptical, some warning of pullbacks. But when the safe haven trade becomes a performance trade, late money arrives, and it doesn't trickle in, it comes rushing. Practical note for newcomers. If buying physical, be aware of premiums and liquidity. If using vehicles claiming metal exposure, know exactly what you own. Always align your time horizon with the trend, not daily noise. Returning to the legal story, it's the spark. Even if you believe the action is justified, the market isn't moral. It reacts to consequences. Public friction between law enforcement and monetary authorities creates uncertainty, and uncertainty drives demand for assets that cannot be diluted. Additional layer, persistent premiums in some countries pull supply from well-stocked regions. That decline in inventories becomes a narrative, which breeds fear, which fuels demand. It's a self-reinforcing loop. Loops in markets don't end because TV analysts say calm down. They end when supply rises, demand collapses, or price forces a reset. Another cliffhanger. If triple-digit silver is the headline, the real story is what comes after. Once $100 loses buying power, people start asking, what will $100 buy next year? That question spreads quickly, amplifying demand. Supporting the channel while staying informed? Hit subscribe, join the WhatsApp channel for rapid updates, and consider membership for deep dives. Share success stories and comments. They motivate and educate the community. Let's recap the week's market action like a narrative, not a spreadsheet. Institutional stress, declining currency, purchasing power, metals holding and pushing higher, ratios favoring silver, physical flows, premiums, vault movements, and retail bottlenecks all underline a consistent theme. The debasement trade continues. Looking ahead, pressure on central banks, political heat, geopolitical tension, and competition for resources keep a strong bid under hard assets. Any economic wobble forcing rate cuts or renewed liquidity could accelerate the next leg. And note, rate cuts now might be interpreted as currency dilution, reinforcing metal's appeal. Old correlations may not hold. Regime change breaks rules. A simple mental model, the old world, trust institutions, chase growth, gold and silver only for panic. The new world, question institutions, baseline protection in gold and silver, chase performance on top. That shift turns metals from insurance into allocation, forcing repricing to ration demand. Finally, let's discuss timing. The biggest moves happen in gaps, between headlines, when one region quietly drains supply, when a major buyer decides to act. One morning, the price is simply higher, and everyone pretends they saw it coming. Actionable points: watch ratios, watch premiums, track headlines for central bank pressure, and monitor your psychology. Markets test patience before rewarding trend alignment. You made it through, already ahead of most. Subscribe, join the WhatsApp channel, and consider membership for full unfiltered updates. Support original analysis, comment OG John AG. This wraps up the 2026 outlook for gold, silver, and critical metals. Legal pressure, institutional stress, global premiums, and currency debasement are the key forces driving this trend. Observing ratios, inventory flows, and pricing across regions allows you to position ahead of the crowd. Volatility will shake out the impatient, while strategic allocation and understanding market mechanics put you on the winning side. Stay disciplined, monitor the signals, and remember, when hard assets move, it's rarely random. It's a reflection of structural pressures, real scarcity, and global flows. Position accordingly, and you'll be ready when the next leg arrives.